The market's short. There's a very large short position, not only in oil, you see it in equities. In general, the investors don't like this space. Why? They're concerned about a big oil supply glut next year. Actually, it doesn't really start until first quarter in terms of analysts' balance tables. When we look at the situation today, it's starkly different. Inventories are low, curve is backwardated, demand is middling, it's not great, but now you have the stimulus package on top of that, and you still have the OPEC production cuts. Now, on top of that, we've thrown in, potential conflict in the Middle East that could take out some energy facilities. So the near-term outlook is positive, which is why the front of the curve is strong, but it's being weighed down on the back end over the fears of this big oil supply.
Jeff, 24 hours ago, we had a 69 handle on Brent. It seems inconceivable. Even a 69 handle on WTI would have been extraordinary, because that's where they start refilling the SPR potentially, or certainly they could. But a 69 handle on Brent with all this going on as well. Is it just about the market being short, or is it also about, despite everything that China's announced, and my goodness me, the biggest bazookas we've seen in a long, long time, that they're just really worried about the Asian demand?
I think that what they were worried about was a price war between Saudi Arabia and the shale guys. Similar to, if you actually think about what the market's worried about, I want to emphasize they're worried about it, but because they try to price it in advance, it's unlikely to happen. That's why we don't really put a high probability on this oil supply glut occurring. But I think the big one is they were focused on a price war between Saudi Arabia and the other non-OPEC producers. We don't think that will happen now. Why? One, Saudi Arabia didn't lose the same type of market share as it did, let's say, in 2014-15, or that it did in, let's say, 1986. By the way, I want to point out, only 2 times in the history of this oil market in the post-war era have we had a supply-driven bear market. One was in 1986, after a decade of big investment from the 70s, and then again in 2014 after big investment from the 2000s. We don't have the big investment this time. Saudi Arabia doesn't have the lost market share this time around. So I think arguing for a repeat of 2014-15 is not appropriate. Also, what happened in 2014-15? China fell apart. Hey, they're stimulating this time around. So it's not the same story, but I would argue it's those fears being replicated that's creating that short.
So Jeff, what was the point of that story? Because it did move markets about whether the $100 price target would be abandoned by the Saudis. Where do you think that came from? What was the motivation for it?
They look at these balances that are done, like, let's say, like the IMF. They go, okay, we look at Saudi Arabia's fiscal position. They need something like a $95, $96 a barrel to be able to balance the budget. That's where those numbers. Saudi Arabia did not say that, by the way. That was, it was really interpreted or implied from those types of calculations. I think the key point there is Saudi Arabia and the rest of OPEC follow the data. They're data dependent, very much like other policymakers, and they're focused on the 5-year average of inventories, keeping the market balanced from that perspective. So I think it was market grabbing onto headlines more than it was based in reality.
Can I just get to China? Because the market, as we talk about a short squeeze, got very active on their short positions on China, and that feels like that's where the hedge funds went. Wasn't necessarily the oil price, was just direct to China equities, China exposures. Is there something on the ground that suggests that the stimulus this time will look anything like stimulus of the past and create genuine demand that would have implications for commodities?
I think they fully understand this, that they need to target consumption this time around. Simply cutting rates and increasing money supply doesn't work in China like it doesn't really work in Europe or Japan, because they're basically bank-funded capital investment. So most likely what we're going to see coming out of this stimulus is going to be like cash for clunkers type of programs, where they actually give the cash in, directly or indirectly to consumers to go buy consumer type products. And a cash for clunkers is typically, the type of system that's implemented here. So I think there's a deep understanding by Chinese policymakers that they need to stimulate consumption here, because you look at consumer confidence in China, it's down. That's what the real concern is. They need to get that up. Best way to get that up is through consumption.